Imagine walking into a bank to borrow money for your dream home. You have a great job, a steady income, and enough savings for a deposit. But within minutes, the bank says, "Sorry, your application has been declined." The reason might surprise you. It wasn't because you didn't earn enough money. It wasn't because you were unemployed. It was because of a three-digit number that quietly follows you almost everywhere: your credit score. That tiny number can influence whether you get approved for a mortgage, a car loan, a credit card, or sometimes even an apartment to rent. Yet millions of people don't fully understand how it actually works. Some people think checking your credit score lowers it. Others believe earning a high salary automatically gives you a good score. Both of those ideas are completely wrong. Today, we're going to break everything down using simple examples. By the end of this video, you'll understand credit scores better than most adults, and you'll know how to improve yours. Let's begin with one simple question. What exactly is a credit score? Think of your credit score as your financial reputation. Just like teachers remember which students complete their homework, lenders remember how borrowers manage their money. Every time you borrow money and pay it back responsibly, you're quietly building trust. That trust slowly becomes your credit score. Imagine lending your favorite game to two different friends. One always returns it on time. The other keeps forgetting. Who would you trust next time? Banks think in almost exactly the same way. They simply ask one question: how likely is this person to pay us back? Your credit score helps answer that question before the bank ever meets you. It acts like a financial report card built from your borrowing history. Notice something important. A credit score doesn't measure whether you're rich or poor. It measures how reliably you manage borrowed money. Someone earning £40,000 can have an excellent credit score. Someone earning £400,000 can have a terrible one. Income and credit are connected far less than most people think. Now you're probably wondering, who actually creates your credit score? The answer isn't your bank, and it isn't the government either. Special companies called credit bureaus collect information about how people borrow and repay money. Every month, lenders report information like whether you paid on time, how much debt you're carrying, and how responsibly you're using credit. Those reports slowly build your financial story. Every payment becomes another chapter, helping lenders understand your habits over time. The good news is that your story isn't permanent. Every smart financial decision you make today can help improve tomorrow's credit score. But here's where things become really interesting. Your credit score isn't calculated randomly. It's based on several important factors, and some matter much more than others. In the next chapter, we'll uncover the 5 biggest factors that determine your credit score, and you'll probably be surprised which one matters the most. There isn't one secret formula hidden inside your credit score. Instead, imagine it like baking a cake. Several ingredients work together, but some ingredients matter much more than others. Out of all 5 factors, one is more important than everything else combined. If you only remember one lesson from this video, make it this one. The biggest factor is your payment history. In simple words, do you pay your bills on time, or don't you? Every time you make a payment before the due date, you're sending lenders a powerful message. You're proving that you can be trusted. But missing even one payment can have a surprisingly big impact. Think of it like dropping your phone. One accident can leave a noticeable crack. The good news is that one mistake doesn't ruin your future forever. As you continue making on-time payments, your financial reputation can slowly recover. That's why many financial experts say this simple sentence: always pay on time. It sounds boring because it works. Now let's look at the second factor. Surprisingly, it isn't how much money you owe. It's how much of your available credit you're actually using. This is called your credit utilization ratio. Don't worry about the complicated name. The idea is actually very simple. Imagine your credit card has a £10,000 limit. If you've used £2,000, you're only using 20% of your available credit. Now imagine someone else has the exact same card but spends £9,500. Even if they make every payment on time, lenders may see them as taking on much more risk. Many experts recommend keeping your credit utilization below about 30% whenever possible. Lower often looks even better. Here's something that surprises many people. Paying your balance in full each month doesn't mean you should max out your card first. Think of your credit limit like a bridge. Crossing it carefully looks responsible. Driving right to the edge every month makes lenders a little nervous. The third factor is the length of your credit history. The longer you've shown responsible behavior, the easier it becomes for lenders to trust you. Imagine hiring 2 employees. One has worked reliably for 10 years. The other started last week. Who would you trust more? That's why closing your oldest credit card isn't always the smartest decision. Sometimes keeping older accounts open can actually help your credit history. Next comes your mix of credit. Lenders like seeing that you can responsibly manage different types of borrowing, not just one. That doesn't mean you should borrow money you don't need. Never take on debt simply to improve your credit score. That's one of the biggest myths online. There's still one final factor left, and it's responsible for one of the biggest credit score mistakes people make without even realizing it. So far, we've covered payment history, credit utilization, the length of your credit history, and your mix of credit. But one final factor still remains, and it's responsible for one of the biggest misunderstandings about credit scores. The final factor is called new credit inquiries. That sounds complicated, but the idea is surprisingly simple. Whenever you apply for certain types of credit, the lender usually checks your credit report. That check is known as a hard inquiry. One hard inquiry usually isn't a big problem, but applying for several credit cards or loans within a short period can make lenders wonder why you're suddenly borrowing so much. Imagine meeting someone who suddenly asks 10 different people to lend them money on the same day. Most people would become a little cautious. Lenders often think the same way. But here's something many people get wrong. Not every credit check affects your score. Checking your own credit score is called a soft inquiry. It does not lower your score. In fact, regularly checking your credit can actually help you spot problems early. Think of it like checking your own weight. Looking at the scale doesn't make you gain weight. It simply tells you where you currently stand. Now let's put all 5 factors together. Think of your credit score as a giant puzzle. Every financial habit adds another piece to the picture. Some pieces matter more than others. That's why one late payment usually hurts more than one credit inquiry. Not every action carries the same weight. Now you might be wondering, what is actually considered a good credit score? Different credit scoring systems use slightly different ranges. But generally speaking, higher scores tell lenders you're less likely to miss payments. Think of it like school grades. A higher grade doesn't guarantee success, but it usually gives you more opportunities. A stronger credit score can help you qualify for lower interest rates. That may not sound exciting, but over many years it can save thousands of pounds. Let's imagine 2 people borrow exactly the same amount of money. One has excellent credit. The other has poor credit. Who pays more in the end? Usually, the person with the lower credit score pays much more in interest over the life of the loan. Sometimes the difference is surprisingly large. That means improving your credit score isn't just about getting approved. It's also about keeping more of your own money. In other words, a strong credit score quietly works for you behind the scenes. It can reduce borrowing costs without you even noticing. But despite all of this, millions of people accidentally damage their credit score every single year by repeating the same avoidable mistakes. In the next chapter, we'll uncover the biggest credit score mistakes, and more importantly, exactly how to avoid them before they cost you money. Let's start with the biggest mistake of all: missing a payment. It might seem like a small oversight, but to lenders, it can be a warning sign that something has gone wrong. Sometimes people don't miss payments because they don't have money. They simply forget the due date. That's why organization is just as important as income. One of the easiest solutions is setting up automatic payments for at least the minimum amount due. That way, even if life gets busy, you reduce the chance of forgetting. The second common mistake is using almost all of your available credit. Even if you pay everything back later, constantly staying near your limit can make lenders nervous. Imagine borrowing a bucket that's designed to hold 10 liters of water. If you constantly fill it to the very top, people start wondering if it's about to overflow. Keeping your credit utilization comfortably below your limit sends a much calmer message. It tells lenders you're borrowing because you choose to, not because you have to. Another mistake is applying for several new credit cards at once. Every application might seem harmless by itself, but together they can create the wrong impression. Think of it like job interviews. Applying for one position is normal. Applying for 20 in the same afternoon might make people wonder what's happening. Here's another mistake that surprises many people. Closing your oldest credit card just because you don't use it very often isn't always the best move. Older accounts help show lenders a longer financial history. That's one reason financial experts often recommend thinking carefully before closing long-standing accounts. Mistake number 5 is ignoring your credit report completely. If you never check it, you might miss errors that could quietly hurt your score. Believe it or not, mistakes can happen. A payment might be reported incorrectly, or information could appear that doesn't belong to you. That's why checking your credit report every so often is a smart habit. You're not just watching your score, you're protecting your financial identity. Another hidden danger is co-signing a loan without fully understanding the responsibility. If the other person misses payments, your credit could also be affected. Helping family or friends is kind, but co-signing means you're sharing responsibility, not just offering support. That's an important difference. Now here's a myth that's everywhere online. Some people think carrying a balance every month helps their credit score. It doesn't. Paying unnecessary interest simply means giving away more of your own money. Building good credit doesn't require paying extra interest. Good credit isn't about spending more. It's about borrowing responsibly, paying on time, and staying organized month after month. By now, you've probably realized something important. Building a great credit score isn't complicated. It's mostly about repeating a few smart habits consistently. But one big question still remains. If your credit score isn't where you want it today, how long does it actually take to improve? The answer might give you hope. Now for the question almost everyone asks. If your credit score isn't great today, how long does it take to improve? The honest answer is, it depends. There's no magic button that instantly adds 100 points overnight. Credit scores reward consistency, not shortcuts. Think about going to the gym. One workout won't transform your body, but hundreds of good workouts over time absolutely can. Building credit works almost the same way. Every on-time payment is another small win. Eventually, those wins add up. If you've missed payments in the past, don't panic. Negative information becomes less important as time passes and you build a stronger recent history. The important thing is not perfection. The important thing is making better decisions starting today. Let's put everything we've learned into one simple action plan anyone can follow. Step 1. Always pay every bill on time. Even one missed payment can undo months of progress. Step 2. Keep your credit utilization low. Using less available credit usually looks much healthier to lenders. Step 3. Don't apply for lots of new credit unless you genuinely need it. Borrow with purpose, not impulse. Step 4. Check your credit report regularly. It's one of the easiest ways to catch mistakes before they become bigger problems. Step 5. Be patient. Great credit isn't built in weeks. It's built through months and years of smart financial habits. Imagine your future self applying for a mortgage, buying your dream car, or starting a business. The decisions you make today can make those moments much easier. A good credit score doesn't make you wealthy, but it can make becoming financially successful much easier and much less expensive. Remember, credit is simply a tool. Like any tool, it can either help you build your future or create problems if it's used carelessly. The smartest people don't fear credit. They understand it. And because they understand it, they stay in control of it. So the next time someone tells you that credit scores are mysterious or impossible to understand, you'll know the truth. If this video helped you understand credit scores better, imagine how much money these lessons could save you over your lifetime. If you learned something new today, let me know in the comments. What's one credit score myth you believe before watching this video? And if you want more simple, visual finance lessons that can help you make smarter money decisions, don't forget to like this video, subscribe to the channel, and turn on notifications. Thanks for watching, and I'll see you in the next one.